Welcome to Chit Chat Stocks. This is our weekly power hour, and I am your host, or one of your hosts, Ryan Henderson, and I'm joined today by Brett Schaefer. As always, we're talking about all things financial markets. This week, we got a lot of earnings on the docket. We've got Match Group, Airbnb, Coupang, and then we're going to talk about the massive rise in capital expenditures at the big tech companies and what it might mean for big tech earnings in the long run. Brett's got some other companies to discuss as well. Tons of topics. As always, we're doing this live on YouTube at 12:30 Eastern time on Thursdays, 9:30 Pacific time. And we post these on our podcast players as well. So if you want to ask questions and you want to listen to the show live, feel free to go to YouTube and check it out. But without further ado, how are you doing this morning, Brett? We had a couple of companies report. So how's the portfolio?
It's doing
Surviving?
all right. Yeah, nothing too crazy. I seem to have had a lot of stuff that had a negative reaction after the report, but then recovers in the days following. So pretty neutral earnings season. I know a lot of people or a lot of the growthier stuff has been hit pretty tough. So I guess I don't know if I'm grateful, but maybe more happy that I'm not in stocks that are down 30%. But nothing, yeah, nothing too crazy, kind of as expected for a lot of earnings reports out there. And yeah, I actually had my portfolio. It's not very big. I think it's only six companies at the moment. I'll probably build it out to 10, maybe a little bit more. They all report within 3 days time, so it's quite a busy period for me. But I'm still reading through these reports, and yeah, we're gonna talk about a lot of them. Very busy earnings season, and I'm excited to talk. I got Shopify, I got Roblox, Coupang. There's really an endless amount. Any suggestions people have, we can go through them kind of
Six
as we go and
companies.
as we record this episode.
Six companies. You're harnessing your inner Druckenmiller, I take it,
No,
trying to
I mean
concentrate.
not that crazy, but it's the personal account building it out over time. It's not like it's a set pool of money.
All right. Well, before we get into the episode further, I'm going to let you in on a little secret. You know how much you hate fees on options trading? You know how these fees can be as high as $1 per contract? Well, public.com has just launched a first of its kind options rebate program that can save you money. In a sleek, modern trading experience, public.com options traders have zero commissions, zero per contract fees, and trading rebates of up to 18 cents per contract traded, depending on the number of referrals you make. That's right. Public.com will give you back money on every options trade, which you can save hundreds or even thousands of dollars per year as an active options trader. It's simple. Public allows you to spend less and get more back on your options trade. Why would you go anywhere else? Check it out for yourself and start saving on your options trades at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Where do you want to start, Brett?
Well, we had a question on Match Group, so maybe start there. Another interesting report for sure. A lot of some positives, some negatives. A lot of thoughts there, I'm guessing. Well, you have the notes, right? Why don't you go through the numbers first, and then we can give our
Okay, I didn't have the
thoughts.
numbers right in front of me. I had my overall thoughts first, but I I think I could summarize it as Tinder bad, Hinge good, stock cheap. Is that fair enough?
MAUs ugly, maybe to add in there. I think that's something that unfortunately they aren't very or haven't in the past been very forthright or consistent about giving out their active users. They only give out like the paying subscribers, all that type of stuff. And now they're saying they're giving out more disclosures on that, and turns out the MAU declines at Tinder monthly active users. The active users on the platform are perhaps worse than we thought. We knew they were declining, and there's just a lot of dynamics there. So I think that perhaps is the most interesting thing to talk about this quarter. But yeah, I totally agree
Let me
with your
summarize the
summary there.
situation. So basically, Tinder has been this online dating behemoth. I don't think that's a secret to anybody that kind of pioneered the mobile online dating space. and they grew into really a global juggernaut. And now they've slowly started to see more competition come in over the years, primarily from Bumble and then Match Group's own app, Hinge. Uh, and so we're starting to see a trickle away on the number of users and engagement on Tinder. And I think a lot of that is coming from competition. However, a lot of it is also likely coming from poor product improvement over the years, poor product development, because Tinder, for anyone that's been on it, probably knows it's not been the greatest experience. It's been crowded by bots and people that are not there for the right reasons. So that's led to people trickling away. However, yes, you mentioned it, they're losing users, but the average revenue from the people that actually pay is going up because they instituted price increases. So revenue overall for Match Group was up 9% this quarter. Revenue in general continues to go up, primarily because of those Tinder price increases that we mentioned. However, the concern is that that's going to start to fade away here as engagement on Tinder continues to drop. However, there was an important caveat in the conference call that a lot of that MAU decrease, or at least a decent chunk of the MAU decrease, was from them getting rid of bad accounts. So that is one of those things that you kind of have to, it's a pill you have to swallow for the quarterly earnings, but it's one of those things that drastically improves the platform for everyone else on it and improves the likelihood that someone's going to pay. So pairs has declined, users have declined, but the average revenue per pair is counteracting that. It's helping Tinder. Hinge, on the other hand, seems to be a perfect business for all intents and purposes. Huge network effect, profitable, and continues to just grow at will. And a lot of it, they're spending money on marketing, but it seems like they don't really have to spend money on marketing just because it's kind of had this virality thing going on at the company. So, going on at the brand.
Yeah, well, they have said that it's less. They've had to spend more on Tinder than Tinder when Tinder was at that size. They've had to spend more, but I think that's just because Tinder was almost a perfect viral business. Doesn't make the Hinge business bad, but not as I mean, when Tinder started, it was such a flash in the pan, or not a flash in the pan. It was like a bomb going off of. I don't know. It was so viral when it started a decade ago.
Yeah. And
Didn't need
so
any marketing.
I guess maybe to summarize the rest here, this business is predominantly Tinder and Hinge. They're having to spend more on marketing for Hinge because they have more of an uphill battle. There's more competition. They got to get their name out there than they did with Tinder. However, they're also having to spend more on Tinder now to kind of revitalize the brand and have people see it not as this cesspool of like bots. Just to be frank, that's what they were concerned about, and so they want it to seem more friendly, primarily to women, is what they've spoken about on the conference calls a lot. So they're spending more. Margins are contracting a little bit. The stock is down like 80%. I think I haven't
From
checked
its
it
highs, not
from
on
its
not on
from its
this
highs.
earnings report. I think it's down a couple percentages now. After today, it's up a little bit. But yeah.
Yeah. So they're repurchasing a lot of stock. They're repurchasing, I believe, if I annualize the current amount, it would probably be close to 10% of their market cap.
Yeah.
So probably one of the cheapest tech stocks out there for a business that's still expected to grow. But the difficulty is that people really don't know where Tinder is heading. So I want to get your thoughts. What do you think of this quarter overall? And then do you think Tinder is actually dying?
Yeah. So I thought the quarter was all right. Nothing too crazy that I don't think people expected, or that I didn't expect. The guidance on Tinder is a little bit rough, where I think they've been setting expectations low, so I'm not too concerned about whatever revenue guide they have there. They talk about eliminating the bots. That's good. Eliminating they call them the unhealthy users, which is just, I think, a nice way to say the people that aren't nice on there. Um, the percentage of like daily and weekly active users as a percentage of MAUs are going up, which is good. That just means that the marketplace of the existing users might be a little bit more healthy. They're talking about making it, they haven't implemented this yet, but users on Tinder are going to be required to have at least one face photo going forward, which I think is a good thing because you don't want those. I don't know. If you're on a dating profile, you probably want a face photo. They're also implementing the AI profile generators, which one of the big hurdles to making a what I might call robust is probably the wrong word, but a fully like a full profile, not just loading up one photo and having no notes on it or in your bio. It takes a little bit of work. So if they can have some AI tools to help with that, that'll help as well. They're talking about really, and this is a multi-year thing, improving the product, and it's gonna take a while. And I'm not sure exactly. They keep talking about, well, the payers will turn around. Well, the users are going to turn around. That is the big if that's in their plan. I don't know how much confidence I have in them, but right now the business is generating a lot of cash. If they turn things around, yeah, we probably get a multiple re-rating and the stock does quite well. But yeah, it's there's a lot of give and take, I'd
So,
say, especially with the
yeah.
Tinder business, where it's I don't think some of the things people look at are not as bad as they seem because I don't think the payers are that big of an issue because yes, some of the payers are going down because as MAUs decline slightly, there's usually a consistent amount of MAUs that I'll pay. So that's going to go down a little bit. But part of the reason it went down is because they're implementing those price increases, which is something they said that they essentially can do overnight. So they can gain revenue if they wanted to by raising prices if they feel that they have the ability to do that. But the product led and the improvements for the platform are going to take a long time because they have to change the reputation of the brand. They have to change a lot of things, and it is a slight turnaround story there. So I'm not I'm not sure on that, but I still
Yeah.
think what's interesting about this business is that revenue keeps climbing. It keeps generating cash. We might see record cash flow this year. Now, uh, I'm a little bit concerned about the conversion from cash flow to their adjusted operating earnings and also the difference between adjusted operating earnings and GAAP operating earnings. I think there is a widening of a gap there, but I haven't run those numbers yet. Like it's weird where the narrative around the business is so bad and it just keeps growing.
Yeah. Mike, so when I read the report, I thought, not that bad of a report. Obviously, some concerns, some headwinds with Tinder. And then I saw the stuff about them kind of cleansing the platform of bad accounts. And I thought, wow, this is all right. But then you listen to the conference call or you read the commentary, and it's just kind of the whole, a lot of the questions, a lot of the executive commentary was around like, it was very negative on Tinder. It was, listen, we're struggling. There's no doubt about it. So it almost like it was almost them admitting we don't actually know what's going on. There are problems. Users are churning away. And then they said we expect to get back to sequential user growth in the back half of the year. Some analysts ask, like, how do you expect to do that? Are you going to raise marketing spend or anything like that? And they're like, no. To be honest, we kind of just hope the product improvements work, was more or less what they said. There's some
Yeah.
other stuff as well, but
Well,
what
I
they're
think they
lapping easier
standard.
comps, but
Yeah.
a lot of it was basically like they were kind of they did the same thing last year. They're punting towards the end of the year. They were like,
Yeah. Yeah, I agree that when they say, look, we're expecting the product led stuff to lead to user recovery and stabilization there's not 100% certainty that that's going to happen. One thing I did like though is that the analyst was essentially saying, are you going to increase like click through marketing spend to increase payers and increase MAUs? And they essentially said, no, we don't want to buy users. We don't want to buy payers just to get a number up. which I thought I liked. They're saying, look, we want to do this in a healthy manner. We want to build a platform that people actually enjoy using and get use out of. So I like that, but they are going the hard route. And I think previously that old management team, you could see it was some of the subscription stuff they would throw out. It would be like, hey, one day, um, I don't know what it would be like one day premium, whatever they call it, and it's like $1, and you can pay for it for just this day, and then that gets the payer number up. So I think they're trying to do it in a healthier manner that's not just manipulating their KPIs, but there obviously are some issues, and I think honestly, is there any other issue at the business besides Tinder MAUs? Because I think if that's
Well,
solved,
yeah.
it's the business is extremely healthy.
Something that's been underrated about Match Group's performance in general over the last couple of years is that the legacy apps were actually making up a decent chunk of the revenue pie. So some of those, like the OkCupid, Plenty of Fish, and Match.com, their trickle away, like it's not that costly because they're not putting money into marketing, but it's actually been a bit of a revenue headwind the last couple of years for them. It's been offset somewhat by the emerging apps, but I don't think that's I think it'll become less and less a part of the pie over time, but it has been a headwind for them. The only other thing I'll add, and then we can move on because I know not everyone really cares that much about Match Group. Watching uh, Bernard Kim come in and try to make some real product improvements and actually move the business forward in a healthy way kind of shows me now how incompetent the previous management team was and how little was really going on in terms of development and improving
Right,
the
they're just
platform.
kinda sitting around doing nothing.
Yeah. Uh, yeah, it's a bummer. I hope that they can actually turn this around because, I mean, they still have the leading dating apps by a long shot. So, other than, the one, which is really Bumble, globally, they have the leading app. So I think they're in the right spot to grow over the long run. And it's just a matter of kind of what happens with cash flow in the coming years and whether or not they can buy back stock. I'm probably going to keep my position about where it's at.
Yeah, I was gonna say, you're holding? No, no sells, no buys.
I don't really see much of a reason to buy after this report. I don't think a lot changed in my mind. It also was kind of funny that they just said like they dedicated a whole page to some like random big headline number that they threw out there. Like Hinge could be $1 billion business. It's like,
Yeah.
okay, we're not going to ignore all the issues at Tinder just because Hinge might be one day a $1 billion business. So,
Yeah,
um,
yeah. Where the stock goes down enough, we get a some of the parts situation. Tinder is free or whatever, you know. You buy this, you get Tinder for free. But yeah, I think I'm in the same camp, just holding. I think if they can't turn around the users this year, probably sell. Not going to win them all, but I see this still as a good risk reward, and they're returning a lot of cash to shareholders. So if things are stable, they'll buy back half of their market cap within the next few years, and it's not bad. I don't think that's that bad. All right, next topic, Ryan. What do you want to hit?
do we want to talk about Capex at big tech?
Sure. Yeah.
Okay. So, for anyone that's followed this sort of situation, I don't want to call it a situation. It's basically been the headline news of this earnings season. All the big tech companies, Meta, Google, Amazon, Microsoft, not really Apple, I don't think, they have all announced that they are going to really start hiking their capital expenditures. And a lot of it is coming from these AI investments. This is not showing up right now. And let me put some actual numbers on this. So in the last year, 2023, Microsoft had $35 billion in capital expenditures. This actually might be cloud capex only. Um, yeah, this chart is just cloud capex. So Meta had 27 billion. They were expecting it to jump to 38 billion next year. AWS had 25 billion. They're expecting that to jump to 38 billion from 32 to 49. Microsoft from 35 to 52. Basically, every company, every big tech company is expecting their Capex spend, especially for the cloud, to absolutely shoot up. This is not reflected in the current earnings. So John Huber, it's something like Saber. I can't remember what fund he runs, but he runs Base Hit Investing on Substack. He has a Substack. It's a great blog. So he's got some quotes here. He says combined capex at Microsoft, Google, and Meta is set to grow around 70% in 2024. As a percentage of sales, capex will grow from 13% of sales in 2023 to around 20% in 2024. So a huge jump. He then goes on to say this spending hasn't yet hit the income statement, but it will in the next few years as depreciation expenses are set to triple in the coming years as depreciation and amortization catches up with today's capex spending. All this is just to say you're potentially paying a much higher multiple, and maybe you should expect earnings to not grow at the same rate they have been now that they are becoming more capital intensive businesses. So, and this could work out. Like this could lead to higher revenue growth, but I think it's pretty uncertain whether or not these capital expenditures are going to have any sort of direct benefit to the actual top line. So I guess any thoughts there before I give this last quote?
I think at least this year it should benefit the top line, but what I think you're saying is that there's this huge anticipation of AI spend that's expected to continue and grow over the next 5 to 10 years. And if that underwhelms, we're going to have a lot of capex being spent here, but the utilization might be lower than people think. So you're going to spend all this money, these expensive semiconductors, building out all these data centers, all this good stuff, and the earnings power behind it might lower some of the ROICs, return on invested capital. I think looking at each company might be helpful because I think when you look at AWS and Microsoft, they're essentially looking at customer demand and then just building the data centers. Yeah, there has to be a little bit of planning over like 1 to 2 years, I'm assuming, maybe even a little bit longer. But they have these cloud customers who are going to spend and they know how to get a good ROIC. They just price it where they get a good number. Now, if demand falls off of the cliff, that's still a concern. But someone like Meta, they kind of, I think they're doing all the spending in a different manner where they have to monetize it themselves, which I think could work out and be more profitable, but it's a bit more ambitious. Google, it's a bit of a mix,
Can you
but
explain that a little more on the Meta situation? Because I don't know if it's everyone quite
just because
follows.
they're not selling third-party cloud services, they're building it all internally
They're not a
for their own
public
stuff.
cloud vendor. They're doing it for Meta's own applications.
Yeah, and they're adding on what I think they're calling it Meta AI, the AI assistant. I saw it on WhatsApp where it's on all their products now. And how many Meta how valuable is that? Like what's your return going to be on that on all these WhatsApp users that don't look at ads anyways?
Yeah, the last thing I need is another general purpose LLM. To
Yeah.
to be
Any
frank,
sort of
like
search type thing. Yeah, we got a lot of those out there.
if there's something that's targeted for a specific use case, like a customer support LLM, that's great. I'm a fan of more and more of these sort of specific layers built on top of GPT or any of the other general purpose models. But just to build another one, I just wonder how valuable it'll really be.
Yeah, I agree. It's okay. We have a comment here from, and this reminds me from the writer of Firm Returns, one of our sponsors. We'll be talking about later. Said the podcast from the circuit was a good one on this topic. I did toss that out on the Twitter machine, and I really wanted to. I want to talk to those guys because they're two semiconductor analysts. I have no idea how to contact them, so I actually just left them a Apple review. Gave you guys a 5 stars. So if you're listening, I left a review and I left my email in there. So email me. I'd love to do an interview with you guys on this topic. Well, one thing that they discussed that I hadn't thought about before, and what I thought was an interesting comparison is if you remember from the dot-com bubble, So leading up to the bubble, there was all these basically computer and internet equipment companies, and they were saying, look, there's going to be insatiable demand for internet services. The internet is going to grow to an infinite size, and it did happen 25 years later. But they're saying you got to buy these equipment makers because they're going to sell all this equipment. We need to build out all this internet capacity, and then a couple years later, we have all the dark fiber, all the capacity that was built, and then there's no demand because you built about 10 years ahead of what was actually going to be there. I worry that the same thing could happen here, where you build out all this supply and the demand is actually growing slower than people think, and I could easily see that happening. We also have a comment here that says John Huber is legit, so hey, go check that out. I did really enjoy this article. So if anyone, maybe I'll even toss it into the chat here. And then we have another comment. If AI demand comes in low, then they don't buy more servers next year. The demand will grow into the supply of the data centers in the worst case scenario. In the best case, they capture a whole market. Yeah, I think that's in how the cloud providers, the hyperscalers look at it. But for someone like Meta, I'd be a bit more concerned. Yeah, I don't know. There's
Yeah, I'm not
also all
100.
this, like,
Go ahead.
there's the GPU costs that might come down, especially because you have a huge investment from all these companies on their internal semiconductor divisions now, which I would say Alphabet way ahead of the game there. I don't know. I wouldn't know. I don't know if that means they're losing in AI still, but
You don't
my
believe in the
psychological log
graviton?
seems to be doing some smart moves. Sorry, you go ahead.
I said, what about AWS's graviton or gravitron or
The
whatever it is?
Graviton, yeah, they're doing the same, but I think Alphabet was first by a few years there,
Yeah,
and they're considered the best besides Nvidia.
yeah. I guess I just wonder. I remember looking at Amazon and I thought all the capex. It's like, yeah, it's obviously a different business. It's very capital intensive, but every time they put dollars into capex, previously, I kind of looked at it and thought this is expanding their moat because it was a lot of infrastructure investments and expanding their logistics advantage. And I think with AWS, they're probably doing it purely because they see the demand. But I just worry that some of the capex that's being put into AI here, I don't know if it's really deepening anyone's moat.
Yeah, that is interesting. Also, it's great when you can spend a lot of capex and know that the ROIC is going to be solid, but unlike, say, over the last 15 years with Amazon, e-commerce and retail, where I have pretty high confidence that this is not going to be an insane return on invested capital, but a good one. With this spending, I have no clue. I'd say a lot of uncertainty about whether the ROIC is going to be positive. I just don't know. There's just a lot of. I think it could easily become the fiber overbuild of 99 and 2000.
Okay, shifting gears here. I'm going to read you a list of stocks, and I want to know if you think any of these, or even it's not something, most of them I'm guessing you probably haven't followed at all, but if they're even slightly interesting to you. So these are 10 stocks that in the last year finally turned profitable. And it took a lot of searching for me to figure this list out because a lot of companies either didn't actually turn profitable or they just aren't really growth. I tried to do the companies that IPO'd recently and they've been like high growth and they were finally pushed to profitability and they just got there. So I got 10 stocks. The first one, Fiverr International. We know this business, Freelancer Network. It finally reported its first quarter of GAAP profitability. So congrats to them. Second one, SEMrush. I think I've maybe mentioned them to you before, but they help companies run marketing campaigns. Another 2 quarters in a row of profitability. Third
Already
one,
veto though. There's a million. That's a dime a
commoditized.
dozen.
All right. Third one, DigitalOcean. They're like a fourth. They're trying to be a public cloud vendor, but they're like geared towards like small businesses. I don't
Sounds
know.
like a terrible business to me.
It does.
We're gonna do cloud, but we're gonna sell it to small businesses. All right.
Fourth one, I think you might like this one. Bill Holdings.
Yeah, interesting. Yeah.
It's basically invoicing software, but they finally reported a positive net income quarter because of the interest income that they hold for customers.
Right. I remember covering that one. We did a show on them within the last 12 months. And it's an interesting one for sure.
5-year revenue CAGR. This is the revenue CAGR, so the
Okay.
annualized growth rate, 75%.
Wow. What's our valuation looking like? Maybe like a gross profit or a.
I did an EV to gross profit of looks like 5 times,
Wow, not bad.
but
Not bad.
gross
It's
profit. And they are not
payments.
profitable on the core business yet.
Yeah, payments is on the one hand, if you get your payments embedded into these businesses, it can stick around for a while. On the other hand, it's a highly competitive industry, and almost every fintech company I feel like has underperformed the last decade. But maybe that means
Yeah, I
there's
don't even know if I'd
opportunities now.
consider
I don't know.
them. I don't know if I'd consider them It's more like software. It's invoicing software, really.
Oh, okay. Yeah, true.
True. All right, fifth one here, Wix. This is a business you're familiar with, drag and drop website builder. Finally had a couple quarters of positive net income. I think they maybe had some like 5 years ago, but then they started investing really heavily into this, not the subscription business, but the commerce business. So any thoughts there? Interesting.
Yeah. I think the stock is at like 120, which isn't too expensive I've been loosely tracking their numbers. It's okay because it could be an AI beneficiary on the one hand because they can help people build websites quicker, and they've hyped that type of stuff up. I mean, they're kind of press release. I don't want to use a derogatory term, but they give out a lot of press releases for whole lot of nothing. But I also think there is
press
some
release
AI risk
happy.
here where this could be heavily democratized if it's much easier to build a website, and it's really easy to build software that builds websites. So I don't know.
Yeah, I think they're a little more expensive here. Okay, I'm going to go through the last 5 here pretty quick. Number 6, Monday.com. I don't know if you're familiar with this at all. It's kind of like a workspace operating system type of thing. It's for team collaboration. It usually starts in the marketing department.
I actually used it at a job once. Yeah. Pretty
Now,
good product.
they've had 2 quarters in a row of positive GAAP profitability. Let me tell you a mind-blowing stat, if I can find it. Shoot, I don't know if I'm going to be able to find it. But customers that contribute more than $50,000 in annual recurring revenue went from 72 to 2,600 in the last 4 years.
Not bad. So they went up market.
Yeah, I guess that probably helps. But the other part is pretty high retention rate, 110% across all customers, and even higher within the big businesses. I think it's interesting to me, and it feels like one of those software companies that actually just like had zero struggles throughout COVID. Kind of interesting.
Right. Yeah. Seems to be well run. What's the big question here, Ryan? Valuation, earnings multiple, or maybe gross profit, because I know they're still investing.
EV to gross profit, 12.7. It's expensive.
A little high, but I remember, didn't they come out at like 40 times sales?
They were probably super expensive, yeah. It's also another one of the companies that's headquartered in Israel, I believe.
Right. Yeah. Got 3 of these here, actually. I think maybe more. I don't know.
Okay, number 7. This one might be one you're familiar with. DocuSign.
Yeah, that's a tough one.
Now, let me try to convince you here. For the last 12 months, last 12-month earnings, they've been positive for the last 2 quarters, if that makes any sense. Basically, they've gotten to GAAP profitability. This is a business that is actually still growing. despite all the executive turnover, all the competition.
Bad narrative. Terrible narrative.
Terrible narrative. Sorry, I just punched my desk in case anyone heard that. The revenue CAGR over the last 5 years, 31.5%. EV to gross profit, 5 times. It is kind of attractive to me. I think there's still a long-term tailwind here.
You might have mentioned this. Are they buying back stock?
I don't remember. But here's the other thing to me. No one, even as we move back into a hybrid world, a hybrid work environment, whatever, no one's looking back at COVID and thinking, man, I miss signing documents in person. It's not like one of those temporary COVID benefits.
Yeah. I think we talked about this stock a while ago, and just the concern is they have to build some sort of competitive edge outside of just signing a document. So you got to make it a much better product. But because a lot of these companies can come up with a commodity product that's very similar, just bare bones signing stuff. So I wonder how important is any sort of add-ons or any sort of. I remember I don't know if they still branded this way, but they talk about the quote unquote agreement cloud. I don't know how
Contract
important that
lifecycle
actually.
management.
Yeah,
Agreement
I
Cloud,
don't
I
know
think,
how
is
important
Adobe.
that actually. Maybe to like lawyers and financial people and accounting departments or something, it's very valuable. I'm not sure, but numbers look okay.
Okay, number 8, Nutanix. I have no idea what they do, so don't even ask. But they got to profitability. Number
Nutanix?
9, got to
Oh,
be one of your favorite companies, Palantir.
Colt stock, baby.
Palantir, almost a $50 billion market cap. To be honest, I don't think anyone really knows what they do, but
No,
it's
I mean you can figure. I mean, they don't know the inner workings because it's like a defense contractor, but you know what their product set is.
no, there actually is a video on YouTube of a product demo that they did. And back in the day, we published a show on them, and I kind of summarized the video, and it does actually make a decent amount of sense what they're doing, and you can see how it's valuable. But I think a lot of people that follow it just see the revenue going up and earnings going in the right direction.
It's. I'm not. Look, I don't touch Colt stocks. Why would you touch a Colt stock? It just doesn't make any sense to me.
Okay, number 10, last one here, CrowdStrike.
Yeah.
Super expensive, but
Mm.
65% revenue CAGR over the last 5 years. And it's a big business. They've turned the corner towards profitability.
It seems like the best run or the fastest growing cybersecurity company. Obviously, that's going to be a growth market. A lot of smart people are in this thing. It's just out of my wheelhouse. It's one that's covered a lot. It seems to be, covered by a lot of funds and stuff like that, and that's fine. But I just don't know where I'm going to get an edge there. And it's
Okay.
spent like if I'm going to buy something that's a little out of my wheelhouse, it's got to be cheap.
Yeah. So to sum up, you got Fiverr, SEMrush, DigitalOcean. Just so you know, if you read the proxies on all these companies, you'd probably veto most of them. Bill Holdings, Wix, Monday.com, DocuSign, Nutanix, Palantir, CrowdStrike. Do any of those interest you? Any that you would
Number
dig into
one,
more?
I would look at Wix, DocuSign, Monday.com more. I guess I've looked at some of them in the past, but I'd like to get an update on those. Those seem like businesses where I could see some durability there, but someone like Fiverr, and I think that's probably why the stock is down so much, is I'm not sure about the durability of the market, especially with AI taking over a lot of that stuff, but who knows? Maybe that's why there's a buying opportunity. All right, we're getting close to, we're over halfway through, Ryan, so why don't you talk about some of our sponsors? Maybe we'll save the FinChat one and make it an embedded one when I talk about Shopify earnings. So if you want to talk about the others.
Sure. 1 second, real quick. Let's talk about our friend at Firm Returns. This is a stock research blog. We've talked about it a number of times on the show. It has global coverage, but it really leans more towards the UK as it's his home market and he has easier access to management. I really recommend just going and checking out his blog. There's tons of free content, and he provides ongoing updates on the companies that he's actually invested in. One of the big ones that he's covered really well, not big in terms of market cap, but big in terms of great coverage, is Tiny Build. It's a video game publisher over in the UK, and he's spoken to management a number of times there. Pretty interesting, I guess, setup in terms of that stock. Anyways, there's also a paid tier that gives all firmers, as he calls them, which is audience readers, 4 in-depth research reports on new companies each year. It's not really on a precise schedule, but they're very thorough write-ups. And I really can't express it enough. The coverage is very broad, a lot of small caps in the UK, which if you followed the show, you know we talk very little about UK companies. So it kind of gives you that home market exposure where someone really knows the actual businesses. But yeah, I recommend going and checking it out. If you use our code firmreturns.com/chitchat, you will get 20% off any paid plans. But also, as I mentioned, lots of good free write-ups over there as well. And then I've got another word from our friends at Public, but I got to pull it up. So why don't we take a little break here, and Brett, I'll let you talk
Okay.
about
We'll split them
Shopify
up.
real
Yeah,
quick.
we'll do various other. Let's talk Shopify. Actually, I have something I want to talk about first, which is more of a note for our show specifically. Actually, let me pull up those notes. So I get updates whenever we get any new reviews, and we did get 2, unfortunately, 1-star reviews this week. One of them was because one of the mics was low. I believe it was on one of our interviews that I did, so that's my fault. Try to not have that going forward, but when you do interviews, sometimes, unfortunately, the other person sometimes has a low mic. But the other one I thought was a classic 1-star review that we get, and I'm going to read off here, Ryan. Then I'm going to read off where the stock has been. So this person was not happy with the 10 rapid fire stocks episode. It said, just listen to 10 rapid fire stocks episode and it was horrible. Why would you comment on stocks when you have no clue about the business? Question mark. One guy is constantly like, okay, that's kind of nonsense. He mentions Factor in relation to HelloFresh. Essentially, and then he goes on and on and on. This person was very mad that we were not bullish on HelloFresh. And I want to say that, unsurprising, like every 1-star review out there, Ryan, stock's down about 97% from all-time highs.
So I will say, in that rapid fire stocks episode, first of all, that is kind of the point of the episode, is we're looking at these things for the first time. It's audience recommendations, that kind of thing. But I do remember saying I think a lot because we weren't that well researched, because it was kind of a first glance. But yes, we do get a lot of 1-star reviews when we talk bearishly about it in companies, or if we're not
And it's
optimistic about
like,
them.
what's weird is that it's usually when we're like right. I mean, we're not right about everything, but it's usually when we're correct that the stock's down like 97%. So here's what the
Never
reason I bring
forget.
these up is, this is why I bring these up, is because I know there's a lot of listeners out there that like the show, and if you like the show, you probably don't even think about giving a review. If you can, maybe toss in one of those 5-star reviews there on Apple to help get that one out of the feed there for new listeners, because
To
I don't
help.
think that represents what our show's about.
Yeah, I think generally most of our shows are quite well researched. But anyways, let's talk about our friends at public.com. Earlier in the show, you heard us mention the investing platform Public. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Should we talk Shopify? Yeah, let's
Shopify,
do it.
yeah. All right, I got some notes here. First off, shareholder letter. Right in the intro, they said, this is a direct quote, "We are building a 100-year company." What do you think there, Ryan? Does that make you more bullish or bearish on a stock? I'm not trying to say this as a leading question, but if you read that, what would you think?
I don't mind, I guess.
It's
I mean,
fine.
at least they're thinking long term.
That's true.
Here's the
It's a
truth.
bit annoying.
I don't love I don't love the Shopify management team. I think they've built an absolutely wonderful platform. But as a public shareholder, I just don't. Maybe it's not my cup of tea. I kind of like people that pride themselves more on the capital allocation side of things, and they don't, I guess, feel as geared towards the public shareholders as much as making the employees happy and kind of having like, I don't want to say empire building, but like
No, here's
they
what I think
don't.
Shopify.
Go ahead.
This is what I think Shopify's number one priority is: feeling superior.
Yes. Yes, they
That
really seem to worry about their reputation. They really seem to worry a lot about how people view them versus Amazon. And it's like that meme where it's like the 2 guys in the elevator and the guy's like,
maddening me.
you're gonna wish you never saw us." And that Shopify and Amazon's like, "I don't ever think about you."
Right, yeah. I'm sure Amazon, when Shopify was growing 100% during the pandemic, they were probably like, all right, let's kind of get on this thing. But nowadays, I believe Amazon's GMV is probably growing quicker. But let's go through some numbers because Shopify, still good business. Gross payment volumes grew to 36 billion in the quarter, representing 60% of total GMV. So that's just now 60% of Shopify payments volume, payments from customers to merchants are on Shopify's internal payments, which they make a lot more money on. And that is up from 56% in the first quarter of 2023. So still climbing. Gross profit grew 33% year over year, 12% free cash flow margins, although we had $238 million in operating cash flow, and 105 million of that came from non-cash SBC. So not bad, but still a little bit of a headwind there on SBC. In Q2, I think they're expecting a slight slowdown to high teens revenue growth. Let me look at some more numbers here as I try to do a little internal FinChat ad for us. I'll share the screen because they have some wonderful KPIs. That's one good thing about Shopify is they are great at sharing metrics. I think Match Group, you can learn a thing or two from them, just giving out consistent metrics here. Let's look at some of the key segments. So we have subscription solutions, which is essentially just the software revenue. Since December 2019, so I guess right before the pandemic, that's grown at 27% clip on quarterly revenue. Actually, why don't we do Q1? Because there is some comp there. 28% growth from March 2020 to March 2024, 188 million to 511 million. Merchant solutions, which is essentially a lot of that is payments, grew at a 48% clip, 282 million to 1.35 billion. If we look at gross payment volumes, let's add some more stuff there. Nice little CAGR. We can do trailing as well. Kind of showing off all the stuff here on FinChat. I guess this is a little bit of an embedded ad. That's grown at 41%, highly impressive as well over the last 12 months there. And now let's go to valuation. Very interesting one. I'd say I'm going to toss up how about EV to gross profit. Unfortunately, not a lot of these companies are very profitable. Okay, let's try to get one that'll go a little farther back. As you can see here, Ryan, did you know that Shopify used to trade at over 100 times gross profit? I guess you probably did, but
Yes, I did.
it's fascinating to remember there. Now, they're today.
It was 60 times sales.
Yeah, exactly. I guess that is. It's hard not to be 100 times gross profit when you're 60 times sales. Today, after the stock fell after this quarter, down back to 20. So huge collapse in the multiple, at least kind of on a top line basis there. And that's right around where they were before the pandemic. But I will say that they were a much smaller business before the pandemic. So I think that should be factored into things there.
Yeah, if I'm not mistaken, there was a point when they were, I want to say it was like 150, almost $200 billion market cap,
Yeah.
and they were doing like $2 billion in revenue.
Yeah. No, 3, but still. Okay,
That's
question for
crazy.
you, Ryan. Today, the EV, I'll give my thoughts after. You go first. Today, the EV to gross profit is 20. Do you think Shopify is cheap today? And maybe tell people where they can find those wonderful charts at finchat.io.
I think the platform is well positioned to grow. I will say that. I would not call this thing cheap, but and part of the reason I wouldn't call it cheap is I'm not necessarily not really sold on their ability to generate consistent cash flow, which for me is kind of how I measure the valuation of a business. So it's hard for me to call it cheap. I think they will probably grow their gross profit in excess of 15% for quite a long time. They're just really well positioned. They have the best platform, and e-commerce just continues to grow. So it seems likely to me that there's a good chance that the stock goes up, but I'm not particularly interested in buying, if that's what you're asking. And to follow it up, finchat.io/chitchat. If you are interested in having a stock research platform where you can see all the segments and KPIs for each individual business, that's where you do it. You get 15% off any paid plans using code finchat.io/chitchat. I want to
Helps
say
us out.
something. Yeah, it
Yeah,
does
I
help
was
us
gonna
out.
say that helps us out if you use that link there. We greatly appreciate it, and the link will be in all the show notes wherever you find it. But yeah, fitchat.io/chitchat save you so much time, makes your investing process really efficient, and it's not going to be the same cost as a uh, Bloomberg terminal. That's for sure. Okay, what else do you want to talk, Ryan? Little Shopify. Actually,
So
let me.
hero and zero of the week. Wait, I gotta say
Okay.
this. Hero
Okay.
and zero of the week. The zero for the week. I'm sorry, Max Levchin. I really like you, but this is you were just asking for it on this. He says, we delivered, this is the first line of the shareholder letter for a firm. He says, we delivered another set of excellent results in our third fiscal quarter. In the parlance of our times, we slayed. The stock dropped 8% the next day.
He said that. That's a tough one.
Are you
That
familiar
is,
with
yeah.
slayed?
I am familiar with the term. Yes, I don't know if I use it that much. Yeah, we don't need to mess with those companies. I'm sorry, you're just not there. I will say though, still want to talk Shopify. We got some good questions from Luke in the chat here. It says, here's some questions I'm wrangling with Shopify. I think he follows it a little closer than we do. If consumer spending slows, how severely will B2C companies like Shopify be impacted? And I will say that, at least in North America, consumer spending is extremely healthy right now. To what degree are consumers relying on credit and BNPL services, so buy now, pay later services, like you mentioned there, Ryan, to maintain their spending habits, especially ones that are doing discretionary purchases on e-commerce? I would say, is the claim resilience in consumer spending a temporary phenomenon driven by dwindling savings, or is it indicative of a generally robust economy? Yeah, I mean, I think with Shopify, like you mentioned, Ryan, over the long term, that should be advantage, but it is interesting to think that, okay, are they growing this quickly? Is gross profit growing at 33%? Is how much of it is just some sort of macro uplift? And I think maybe some, and I think if you're gonna buy today, especially at a gross profit multiple of 20, you'd hopefully expect, a good amount of that to convert to free cash flow over time, as they scale. You really need to be confident that the quote unquote, terminal growth rate, or the growth rate even 5 years from now on a top line perspective, is still gonna be like 15%, right? So that's one where I do have struggle. And with these questions about kind of the macro consumer spending, if you're, I think if you have Shopify on your watch list, if you're really confident in the mode of this business, it's one where you would want to buy when the numbers look ugly during a recessionary period, because there's going to be analysts out there worried about the next quarter. That's what I think.
Yeah, I don't particularly worry too much about like consumer spending contracting really quickly. I think if it does, that hurts everyone.
It's hard to
And
predict too.
still, I would say the businesses that have competitive advantages today, that just, if anything, they're probably amplified during difficult times. So it could certainly affect the stock, but I don't see it affecting the business over the long run.
But that's where I think trying to be a bit proactive is, that's where you could maybe expect a buying opportunity to present itself, and then not being afraid if the stock falls 50% to take a position.
Yeah. Yeah, I think that's fair. It feels to me like I've said this before, but it feels like we're kind of in no man's land with equity markets right now. There's certainly some stocks that I think are cheap. Individually, everyone obviously thinks that it's like stocks are in no man's land except for the ones in my portfolio. The It just feels like I'm not if we kind of model these out, the returns don't look good for most companies that I'm looking at. Valuations feel a little stretched. So this is where I think, going back to that Druckenmiller episode we did, it's so valuable to know different asset classes and to be able to say, I'm taking a break from, maybe not a full break from equities, but I'm stepping away. I'm going to reduce my exposure to purely stocks right now because it's just, maybe you don't see the return there. Whereas you could
Yeah.
get fixed income
Good thing I
earnings.
only know stock investing. Um, yeah, I
Now's
think
the
that's
time, Brett.
to learn.
No better
Yeah,
time than the present to learn about fixed income strategies and shorting.
commodities and currencies and all that stuff. Yeah, that is a
What's
tall
your
task.
order?
So what?
What's your order for things you would want for asset classes you'd want to learn next?
I think
And
I would
consider
like
shorting an asset class.
shorting would be the one for sure. I don't have the capital to invest in fixed income, so I'm a little far away from that. You need a little bit more sizable chunks. But I will say, I think for a lot of people, they just go long stocks. They just own stocks, right? I think taking that quote or that lesson, and I will say, if you missed it,